Welcome to The Derivative by RCM Alternatives. Send it. Hello there. Welcome back, everybody, to The Derivative by RCM Alternatives, where, did you hear? We launched a new website. Go to rcmalts.com to check it out and drop us a comment. Speaking of which, you guys have been great on the comments lately, especially over there on YouTube. Keep them coming, but still waiting on some guest requests in there. Someone surprised me. Put someone fun in there that I can reach out to. Okay, on to this episode where we chat with the ever-energetic, somewhat frenetic Gavin Filmore of Tidal, the ETF white label platform that's been on its own frenetic pace, growing to close to over $80 billion with a B in assets using them. What inning are we in for ETF growth? How much do I need in the bank to launch an ETF? Is first mover still the biggest advantage in ETFs? We tackle all of it and more. Next, send it. All right, everybody. We're here with Gavin. Gavin, how are you?
I'm great, Jeff. How are you doing?
I'm great myself. We're just talking offline for a
Knicks
second.
won the finals. We got soccer. Everything's happening right now.
Have you been to any of the World Cup games?
I've been invited 3 times and couldn't do any of the 3, so I'm missing the opportunity wildly.
And now New York people I know is like, hey, if we can make the grass that great in MetLife Stadium, like, change it for the Giants and Jets, right? Like,
yeah, but that's never going to happen.
Why? Like, you just did it.
Well, they have to win games before they can invest, I think.
Got it. Are you a longtime New York fan?
I'm a longtime New Yorker, and sadly, a friend of mine had Jets season tickets, so that made me a Jets fan as a child. And, it just seems disingenuous to switch teams, but I'm thinking about it.
You and Larry David, right?
Exactly. We're all thinking about it.
The 2 super fans. Who'd you just get? You got some good quarterback, maybe.
Those are details that people that know me well know that I wouldn't know the answer to that question. So Jeff, sadly, I have no idea.
There you go. I don't know either. Yeah. It'll hit me about halfway through.
I'm a little too focused on ETFs and derivatives, bluntly.
Right. But Knicks, real quick. So you got the Knicks win. So whatever the Jets do is just gravy, right?
This is where New York is riding high after the Knicks win. Anything else from here is, as you said, gravy for sure.
How crazy was the city after that? Like, things were burning, or they were rather respectful?
It was a little crazy, but I think on the positive side of the spectrum, it was infectious and it was energy, at least from the sports perspective, that New York hasn't had in a long time. So you could really feel it. It was pretty wild.
And then we'll jump into it now while we're talking personal stuff. So what was your background? So did you leave New York for a bit, go to school, or where'd you?
From New York. I went to Northeastern in Boston for school, which was like, as a native New Yorker, I thought Boston, I had literally never been there before, Jeff, right?
You're going very far away. Yeah.
Boston's another big city, right? So I'm sure it'll be like New York. And it wasn't. I mean, it was great for school, but it's just so much smaller.
Yeah.
So then I beelined right back to New York after college and just kind of jumped into the Wall Street thing, if you will.
The Wall Street thing. I think on my 21st birthday, we were in Boston and got in a fight with the Northeastern football team at a bar. I think we won. Right. Yeah, I think we won.
That sounds like quintessential Boston.
Bostonian. Exactly.
Yeah.
What'd you say?
Just perfectly Boston.
I wanted to start, I feel like everyone in our industry, all the podcasts I do with guys who have an ETF, we kind of gloss over the growth in ETFs. Like, it's been such a story for so long, it's kind of just stated fact now. But take us, if you could, on a little journey of like what that growth's been like, if you've had kind of a front row seat your whole career.
Yeah.
And kind of any stats, or just generally why and how has ETFs gotten so big?
Yeah, I'll probably avoid like the stat dropping, right? Because I think like we can all go look at that.
Yeah.
We probably see it in our feeds like every single day. So the stats are the backdrop, but at a high level, I'll start like with where we are today and maybe go backwards a little bit. So the growth is insane. I think every year, somebody wants to like short that growth rate, right? They're like, it can't keep going at this rate. It can't keep going at this rate. And instead of it going down, it actually just continues to surprise us, right? By like the count of ETFs, by the number of filings, and probably most importantly by the AUM, because the AUM drives revenue. So like the rest doesn't really matter if the AUM's not there, but the AUM is constantly there. So if I'm asked like where we are on that growth curve, right? I'll use like sport analogy, even though I'm not a sports
Yeah.
person. And I think about it as like, what inning are we in? So I think I literally said this yesterday. You know, if you ask me in a vacuum, not data supported, just gut feel, I'd say we're still in like inning 2 or 3. I'm
Really?
sure I could be in like an intelligent conversation with somebody where they would argue maybe inning 4 or 5. I think if somebody tried to convince me we were like beyond that inning, I would just stop having the conversation because I wouldn't respect the conversation anymore. Like there's just no really good argument for suggesting that this growth rate is going to slow or not continue. It it is, right, because the data supports it
And it,
consistently, time and time again.
yeah, I'm going to lean right into you calling me inadvertently a stupid person, but I would feel like it was like seventh or eighth inning, right? It feels like
I
it's
mean,
just
yeah. So
the
my
amount of time that's gone by.
well,
But if you're saying like the under the hood, the number of filings, the number of new
yeah,
participants, all that stuff is like hugely growth
yeah.
versus
So
in the
now
back in the day.
let's add time sort of to the
Yeah.
conversation, because I think that's the other great way to think about it. So we I think we're in like 31 years of the
Mm.
ETF industry, right? So we crossed like the 30-year anniversary somewhat ceremoniously. I think some point last year. I don't remember the date, but whatever. So we're roughly 3 decades in, uh, which feels like a pretty long time, right? Like
Yeah.
the world changes much faster than decades at this point, right? When we think about technology and other industry. So that's probably why you're not a stupid person. You could say, well, we're 30 years in, and like, surely we're in the later innings of this. The counterpoint would be, if you look at, again, I'm not going to bring the data points to the conversation, but if you just look at how many assets are still locked up in mutual funds, right, versus the assets in ETFs, that would suggest, or very significantly probably support my side of the argument, which is that we're still early days. And I think when we zoom in on the industry itself, during those 30 years, it paints kind of a different picture, right? So you could probably pretty quickly say decade 1 and decade 2. So basically, 1990 through 2000, what did you have? You had an ETF industry that was growing and successful, but it was rather like vanilla, and I would go as far as to say boring, right? So you have
Yeah.
basically nothing but passive ETFs. Most were just equity passive ETFs, and there wasn't a lot else happening yet. So now you zoom in on the last decade, and I think things get a lot more interesting. And the two main drivers of that would first be active ETFs, and then the second would be, these kind of go hand in hand to a certain extent. The second would be the utilization of derivatives, or you could, maybe it's not just about derivatives, but just more exotic product,
Yeah.
more sophisticated product, more complicated product, which rhymes with more use of derivatives. But the point really being, you can go as recent as 10 years ago, and there was still a healthy dialogue debate if active ETFs were truly going to be embraced and supported with the ETF ecosystem. 3, 4 years ago, that ship sailed, right? And it was gone. Like the conversation was over. Clearly, active ETFs were going to grow. They were going to be adopted by users. And we see the growth now within active ETFs accelerating. Then you hone in even further and you look at derivatives, exotic product, and you see that as another area of massive, massive development. So maybe, ETF industry at large is 30 years old, but you hone in on now, you just really adopted active ETFs at a large scale 5 years ago. And along the same timeline, you're starting to use derivatives more and more, which just leads to so many more styles of product, which creates all this new room for growth, basically.
And as you frame it, the 30 years to me sounds long, but just because that was ever since I got in that fight with the Northeastern people,
Mhm.
right? Like basically my whole career has been hockey stick up for ETFs.
Yeah.
But in the grand scheme of things, how long stocks have been around for 300, 400 years or something, right?
Right.
So 30 out of that is nothing. You mentioned active versus derivative. Do you think those are two different things, or are they two different things? Has you
Yeah.
guys
They're
categorized
like,
them?
they're like overlapping themes that sort of support one another. So this gets, I can take this like many different directions, but kind of selfishly, for myself, I spent the first kind of 15 years of my career at big banks, primarily Barclays. Barclays was unique in the US. It didn't have an asset manager. So that basically
Mm.
isolated our involvement in the asset management ecosystem to passive product, right? So all I was doing as it relates to ETFs, or, I also ran the ETN business there, and we worked with 40 Act partners and mutual funds. It was all passive. I also was operating in an exotic derivative business there.
Mm.
So I basically was taught, trained, and really only honed my skills around adapting derivatives to passive indices.
Where the
I
exotic
then,
was the exotic desk trading against the flow of the or with the flow, right? Like because you were
exactly right.
warehousing that offset the risk.
Yeah,
Yeah,
exactly
yeah.
right. Right. And then roughly almost 5 years ago, it'll be 5 years in September, I've been with Tidal. It probably took me like, Jeff, like literally 3, 4 months to realize, once I was inside of the ETF ecosystem during the last 5 years, which, happens to align exactly with the timelines I was just talking about with respect to active and derivative utilization, realizing that honestly, I don't know that I ever would want to design a passive product for a derivative based product ever again.
Mm.
So I'll say it back and then I'll explain myself, right?
Please.
If I was designing a product today, and I do this, most days, right? If I'm designing a product today and it's a derivative based product, it's going to be exceptionally rare that I actually think that should be built on a passive index. Some of where that comes from is bluntly, and this gets interesting quick, Jeff, and we'll see how far down this rabbit hole we want to go. Some of it's
All the way.
scar tissue that I saw firsthand during my time at the banks. So specific example, right? Which is a good one. I ran a oil based ETN. I ran that product when oil went negative.
Oh,
Okay. And we
there's a podcast for
fortunately,
that. We've got the podcast. That's how long we've been doing this podcast. We did a podcast right after oil went negative.
yeah,
Mm.
amazing. Right. So I was in the driving seat of running that risk
Ooh.
during that event.
You
And I
still
was
have
doing it
hair?
on
Yeah.
index based product. And in essence, for a period of time there, we had no control over the situation, right? We were absolutely obliged to whatever the rules of the index were. We got
Mm.
very, very lucky and it rolled from April to May, like a week before it went negative. And then we were able to shut down the product before, as quickly as we could. But we rode the May contract. I think it got to like $6 or $7. So it wasn't comforting,
Mm.
right? For this like month-long period. Now, if you're running an active ETF, you could have easily gone further out on the curve, right? You could have done all kinds of things to like avoid
Yeah,
basically a
emergency
missile
powers.
attack.
Yeah. Were the rules, who manages this stuff? SEC, FINRA, both? Right?
Well,
Were the,
honestly, manufacturers of product, right? Those are my words, but like, if you're running product, if you're designing product, you're designing index, you're basically manufacturing product. Today, with all the tools at your disposal, with the regulation as it stands, you're in the driver's seat of design. You
yeah.
get to design, if somebody is working with Tidal to launch an ETF, right? One of the first questions we will assess is like, okay, the product that you're thinking about, is that active or is passive, right? That's a huge like bifurcating decision. Sometimes we're guiding our clients with that decision, sometimes we're not. But what is great is the regulators, the prospectus ability to draft a prospectus, the support of product when you think about like market makers and the ecosystem around the ETFs, there's no real constraints there. There's
Mm.
there's not actually a lot of limitation. So instead, you're in control. Now that puts pressure on you to make the right decisions, basically, right?
Yeah.
And you learn from your experience and things like that to say, okay, like you may have a product, let's say it's like a listed option, I don't know, like an income product, right? That's overlaying options. you may basically be able to say, hey, I could design a mousetrap. I basically want to run it systematically. Okay. Does that mean you should do it in a passive ETF and track an index? Or do you just basically want to run it systematically, but because of like, in my words, my scar tissue or your own experience or these edge
Yeah.
cases that you literally cannot predict, hey, maybe we should just run it as an active ETF so that even though 99.9% of the time I'm going to run it systematically based on the recipe that I want to run it with, I might have an unforeseen event that means that I want some flexibility, right? And that's where I would guide people towards today. Like buying yourself flexibility has
Yeah.
huge advantages, many of which you can never predict, right? If I go back to Jeff, just real quick, that oil example, I remember a trader on the trading desk a year prior to oil going negative, suggesting to a group of very smart people, including myself, that, hey, oil could go negative. And he basically got laughed at. Right? Literally, like that's a true
Yeah.
story.
What?
Basically got laughed at. And a year later, right, he looked really, really smart. And I tell that story just to suggest that things happen that you
Crazier
cannot
things have happened.
predict.
Yeah.
So you want that flexibility.
And it's weird just thinking out loud, like you have these complex option traders who, if they go passive, take away all their optionality in their business. It's like, think about optionality on multiple levels, not
Yeah, yeah,
just
yeah.
on your design.
Exactly. Yeah.
But in the beginning, was it the regulators or legal? Like, why was everyone doing passive? Just
Yeah.
that's how it
So
was done. Like, what was were lawyers saying like, oh, no, you can't do that. That opens up a can of worms, or
yeah.
did
I mean,
something
some
change?
of the history I won't nail because it probably predates my level of
Yeah,
experience
yeah,
in the industry, but it is a healthy dose of regulation. And then once, but the regulation's been there, right? I think like first active ETF goes back to like the early 2010s, something like that. But then you had this like long period of not much adoption and not much product development. The factors driving that, I would probably say, are twofold. One, was the ecosystem around the ETFs ready to really support those products well? So again, I first think about the market making community. So what I've found happens with the market making community is, they wait and see a little bit to make sure that the investment in the work that they would have to do is really going to pay off. So
Hmm.
they're not necessarily going to build all of the rails, all the pipes, all the plumbing because it's expensive to do that just based on an idea, right? They actually want to see a little bit of momentum behind it before they do all that work. And let's not shy away from examples where things didn't pan out as predicted, right? So you could look at like semi-transparent ETFs, for example. Flop. No
Yeah.
disrespect for anybody that worked on that innovation, but that is a total flop, right?
What
And
were
a
those? I
lot of,
don't even remember those.
say
They were
again, Jeff.
semi. What were those? I don't even remember
So
those.
there was this huge and it was met with a lot of excitement, and certain people thought it was going to totally radically transform ETFs and be another growth driver, or semi-transparent ETFs, because the thinking was you have all these active managers who love the ETF wrapper but don't want to expose their holdings or their IP to the market.
Hmm. Yeah,
Fundamentally
yeah,
makes sense. So then you had firms, three in particular, basically built solutions and heavy work with regulators, heavy work with market makers, heavy work with exchanges, and all the work was done, and it worked. Right? Like you could run those products. Nobody wanted those products. Now, this goes off on a tangent, but it probably was because what are some of the foundational value propositions of ETFs? Well, one of them is transparency. So you're
yeah.
going to rip one of the core value props of something out of it. Don't assume people will actually adopt it. So I went down this road because that would be an example that like the market making community could look back at and say, well, we invested all this time and money in it and it didn't pan out. It didn't work out. So they're going to be careful, right? They're going to want to make sure that the growth opportunity is there before they invest against it. Active ETF. So back to this active ETF story. While they've been around for 10 going on 15 years, roughly, but the first half of that timeline, let's just make it simple, right? So the first 7.5 of 15 years, they were not widely adopted. The question was why? Well,
Yeah.
one, because they probably weren't operating that well for a period of time because of the ecosystem around them. The second, and I think this becomes interesting in a variety of ways, hopefully, is there actually just wasn't that much innovation happening either. So you have active ETFs, but you basically had the same players in the ETF ecosystem. Think the juggernauts, right? The State Streets, the Vanguards, the BlackRocks, and they were high on the hog, passive business going great. And you didn't have other regulation change that allowed more managers to come into the market there yet. So 6C11, which drove that change, didn't happen until like 2018. So up until 2018, it was hard for new managers to get into the ETF ecosystem. So that just
It
wasn't
basically wouldn't get approved, or it'd take 3 years or something.
exactly, and
Yeah.
way more of an investment. So yeah, you had this new tool at your disposal, but you basically didn't have anybody new that could use the tool. So these things had to converge, which really happened in the later 2010s into, the current decade. And now you have all of these catalysts, right? You have a new derivative rule, 18F4, you have 6C11, and you have increased innovation. The driver of increased innovation, in my opinion, is increased success, right?
Mm.
If the ETF industry is growing and making more and more money, naturally, more and more players are going to want to get involved, right? That's just like core business school type stuff, right? You see that
Yeah.
in cross industry. So now the market opportunity is so large and so appealing. You've got everybody looking at it and all saying, how can I get involved? How can I participate? That doesn't mean it's easy, but the opportunity is big enough for their focus to be there. And that's going to push innovation. So we just see the rate of innovation absolutely accelerating by any count. And you see that in terms of new entrants, you see that in terms of the number of filings, and you see that in terms of the number of launches.
As you mentioned, the market makers and the innovation, this just clicked in my head. Like back 25 years ago, someone was like, hey, I'm going to do an ETF, and it's just the Mag 7, even though that wasn't a thing back there. But these 7 stocks,
Yeah.
and the market maker's like, cool, I can track that. I can take the other side. I can make a market on it. And then someone 6 months later comes and says, I'm going to add bonds to that. Can you handle that? So basically that's what happened, right? It just iterated over time of like, and I'm going to add this piece. Now I'm going to sell options against that.
Yeah.
And the market maker had to crawl along and be like, okay, I guess I can add that. I understand that.
Yeah.
Essentially what happened, they just like got dragged along of like, and I need to add this, and I need to add this.
Yeah. Dragged along's a good way to say it. So let's use finite examples. 5 years ago, I started Tidal. We were working with the market making community already, as you would expect. But then we started pushing the innovation curve, right? So we started building a lot more products. Specifically, let's talk about products using listed options, right? So we started using products with listed options, and you realize that the market, let's just for simplicity say there's like 10 core market makers today operating in the US ETF ecosystem. If I go back 5 years ago and I want to do products with listed options, you would probably shrunk those 10 down to like literally 1 or 2, right? And this was only 5 years ago, who could really accommodate let's not say accommodate, who could really support those products and support them well. You fast forward to today, 5 years later, and essentially every single one of them can do it, right? Because they saw the growth, they saw the opportunity. And at some point, like it was almost forced upon them, right? Because if you are an ETF issuer and you are working with a market maker that's been a key partner of yours for a long, long time, but they are not able to accommodate the new needs that you have, you're going to have to start working with more and more partners. So they all caught up rather quickly, but it was, 1 or 2 in the early days. A couple more came along, and then the rest had to follow. They kind of got dragged there. It's like you either do this, you build it, or you will be out of this business, or at least significantly diminished in the business.
And just wrap up the market makers, they need to understand what you're doing as an ETF manager to make a market, right? Because it's traded every second. I can come in, I can buy it, I can sell it 2 seconds later. So the market maker needs to understand what's in your book, whether that's changed second to second, and then make a market on it for that investor.
And there's other challenges, right? So you're actually, your example that you kind of made up was like, okay, 30 years ago, it's 7 stocks, but then you come along and you add bonds. Okay. That doesn't sound that complicated, right? Because like these market makers they certainly had desks that knew how to price bonds really, really well. They certainly had desks that could price equities really, really well. That's pretty simple stuff. Oh, but actually combining cross asset into a single product means that you need cross piping right between those
Mhm.
desks. So that we also saw that 5 years ago as a real constraint. Only a couple market makers could support cross asset product. So there's multiple factors that can make a product harder and harder, right?
So you're
Active is
yelling at the
harder than
guy like, "You have a bond desk, just talk to them." They're like, "Well, we don't work that way." You're
yeah.
like, "Come on."
But well, sometimes it's that, but it's also to your point. This is we're talking now like second to second stuff, right? So this isn't talking. This is piping and plumbing. This is being able to calculate two different assets, combine them, understand what your risk is, create the right spread around it, and therefore you needed real connectivity between those desks, not just relationship connectivity.
Uh, and do you think the end investor takes it all for granted? They're just like, "Oh, I want this uranium company ETF." Like, just click the button. That's probably a bad example, but whatever. They want this option alternative income ETF. Click the button
Yeah.
and just have no idea what's really going on under all that piping.
I think they do take it for granted, and that sounds like negative to the end investor.
Yeah.
I don't
No,
think
but
so.
it's
Like, why should they care? Like, I don't know, Jeff. I'm going to go outside of industry, right? Like, you and I go on Amazon, we click a button, we
yeah.
buy a toy for our kids. It's sent from. I don't care what's going on inside of
Yeah.
the machine, right? I just care about the outcome, and that makes sense to me, right? The ETFs. I talk about this all the time. It's shocking to some. ETFs are direct to consumer products, right? You can click a couple buttons, you can buy an ETF, right? They're almost like frictionless in contrast to like, tangible goods
Yeah.
that are also direct to consumer products. So should an end consumer, I don't want to go off like other tangents, right? But we talked about the educated. Of course, we want the end consumers educated, but at the same time, like an end consumer should be able to buy an ETF, understand what it's meant to deliver with, yeah, I don't want them to have to like appreciate the work or the challenges or all of the nuts and bolts that went into the product. Like they should be able to trust it's a 1940 Act product. They should be able to trust that it's built well and be able to trust that what it's designed to do, it will do, right? With an understanding of the risks that are well disclosed and educated around. But I wouldn't expect them to
Yeah.
have to understand all those things.
But to reframe it, like the invisible hand of all those hundreds of millions of investors, right, has been like, this is working. Like they're tracking it. It's not far afield. I'm not like getting some price in the ETF that's way off from its underlying. So
Exactly.
the
Yeah.
success is happening.
Yeah. And I think and investors tend to be pretty good at like waiting for the proof to be in the pudding, right? So they will watch and wait sometimes, at least some segment of the market, to make sure these things work. If I go to good industry examples, not stuff that I was directly involved in, but if you look at defined outcome as call it like the biggest scaling story over the last like 8 years of more complexity, listed option utilization, you know, complicated for market makers, right? It kind of brings together all of what we've been talking about in a specific example. I
Yeah.
think a lot of allocators were like, well, I want to wait and see if it delivers exactly the outcome that it says it delivers. And of course, the salespeople or the manufacturers of that product would be like, of course it will, right? I'm building it with listed options. This is what listed options do. It will absolutely deliver exactly what I am telling you it will do. And what is a rational response to that? Great. I'm going to wait and see. I'll
Yeah.
trust it when I see it. And therefore, right, the growth rate in like the defined outcome space was much slower in the first few years than it was in the few years thereafter because you had all these proof points. It's the same thing with like, if you're going to pay an active manager to manage a simple product like an equity, well, you should be paying for performance. It's active, yeah. Like it's
Yeah.
pretty simple. Do you just believe that they're a good active manager? No, you want to see track record. You want to see live track record. And in the case of ETFs, you probably want to see it in the ETF wrapper before you believe it. So you might have to print some performance, and then they're going to say, okay, this guy's a good manager. This woman's a good manager. I'm going to give her my money, right? That's all very rational behavior, and I think we see that work through in the industry.
And then even some of the more sophisticated investors are looking at that spread by the market maker, right? Or is that an important piece of the puzzle of like, hey, if that spread is wide, then even the market maker doesn't quite get what's happening?
Yeah, So
and you
I
should
think
put a yellow
that's,
flag up.
yeah. And Jeff, I think that's actually an area where like education can continue to get better because it's a very common pushback of an ETF for an allocator. So, especially in the early days, right? You don't have a lot of volume. Your spread on screen, right? On screen,
Mm,
oftentimes is not going to look great. Now, if you're well educated in terms of the market, you understand there's liquidity that exists off screen. But there's thousands and thousands of wealth managers, RIAs, advisors, across this very large country. And their level of knowledge and sophistication varies greatly. And by the way, it's the easiest excuse to get a salesperson out of your office, right? So I
yeah.
think sometimes there's just, they do it for that reason. It's like, well, your spread's bad, get out of here. So they might actually appreciate the true liquidity of a product, but just use it as a means to
Got
get
it.
you out of the
So
office.
you're saying it's not necessarily the case that means it's a too
Absolutely
complex
not,
or
right? You
whatever.
should,
Yeah.
in theory, like the spread should be sensible and it should be able to be done at scale in the vast majority of products because what's inside the portfolio is liquid and that should basically be for simplicity pass through liquidity. But if you just like hit the liquidity on the screen, especially at size, you're gonna have some very bad outcomes. And instead you have to handhold the print a little bit, right? You have to use a block trading desk. You have to talk to the ETF issuer to understand who the lead market makers are. You have to connect some, information to make sure that the experience is going to be very good. And let's be blunt here. Appropriately, people are pretty lazy, right? It's like human nature. People are lazy. So you're asking them to do more work in those early
Yeah.
days. And that definitely, can just move people along, right? They'll just say, well, I don't want to deal with that.
Yeah. It's an
I want
easy.
the click and trade, liquidity of SPY right now for every ETF I trade. Okay, like I can appreciate that, but at the same time, they have to appreciate that their clients have different needs. Uh, and the 60/40 portfolio is not going to serve the end client like it once did or will. And there's more and more demand from the end client saying, hey, I want to use more sophisticated products to get diversification, to get protection, to get leverage, whatever the end client wants. So you're going to have to come along that journey too. You're going to have to learn these realities better and better, because otherwise, at some point, you're going to put your wealth management practice at risk too, because those clients are going to say,
Yeah.
well, if you're not going to embrace this innovation, I'm going to go to somebody else that can.
Right. I can see that. Short sighted, like we only allow you to invest in penny wide spreads. Like, okay, well, you only have these 25 ETFs,
Right.
right? Like, what about this? There's a value to all this other stuff they're doing if it's 5 cents wider.
Yeah.
And
So
if you're
there's some
holding
healthy
it for a
balance.
year or 2 or 5 or 10, like, who cares?
Totally.
Yeah. Let's circle back. You've mentioned Tidal a few times. So, on purpose, was in this space, said we want to grab onto this growth, was stumbled into it. Like, what was the path there for how you guys have succeeded so well in this space?
Yeah. So if we zoom out on the history of Tidal is roughly about 14 years old now in some form or another, right? Formerly by another name, Taroso, right? And now just Tidal for simplicity reasons. Up until 2018, there was fits and starts of the business. There was a variety of different things it was trying to accomplish, always around ETFs, right? It was never about anything but ETFs. But at some point, it was more around consulting for growth and sales and marketing and this and that.
Mm,
And it was 2018 where, specifically an individual, Eric Falkeis, joined up the other founding partners who are Guillermo and Dan Carlson and Mike Venuto and said, okay, like, I think you have something here, but to really build a business that can scale and bluntly, Jeff, right? The economics, like have basis points, like consulting is really hard. It's fixed cost, right? Like you want carry in product, you should build a white label platform. So ultimately that culminated with Eric joining forces, right? And they built in 2018 Tidal pretty quickly. So that's like, just let's make it really sharp. So
yeah.
that's when Tidal as a business became a white label platform.
And a white
And
label platform, you have a trust where if I want to start an ETF, I come to you and I can go onto your trust,
well
but
said.
it's still under my banner.
Yep. Well said.
Yeah.
Right. There's all kinds of
Yeah.
nuances and details, but what you said, Jeff, is exactly right. No reason taken any further. That's what an ETF
Perfect.
white label
Yeah.
provider is. Title has this versus others and this and that. But yeah, foundationally, if somebody wants to launch an ETF and they want to do it cost effectively, at speed, with the help of ETF experts, they're going to join forces with a white label provider to do it. And so we start that business in 2018. Immediately, quite a bit of success, by the way, right? Big clients like SoFi in the early days, very large RIAs like Eris Evoque, 20 billion plus, start doing risk parity strategies, right? And early on, like a little bit more on the innovative curve, right? Early utilization of active ETF, an appreciation for what really will drive growth of ETFs. So the foundational base was built starting, in my opinion, in 2018. Over the 2018 to 2021 period, steady, healthy growth, right? Launching like 10 ETFs a year, signing up new partners, big names again, the SoFis of the world, the RIA I mentioned, Blue Cross Blue Shield of Minnesota, right? Institutional names. So that gets us to about the time I joined, and a few things really accelerate, right? And
Thanks
it's
to you,
this.
right when you joined.
Well, I would not go that far, but there was some intentionality, right? Why do you hire an exotic structurer from a bank, which is what I had done the 4 years prior to that, right? So 2017 to 2021, I'm an exotic structurer from a bank. What is an ETF white label provider doing hiring an exotic structure from a bank in 2021? In 2021, that would have felt odd, right? And I can tell you, like, people I worked with were like, what are
Yeah.
you
Like
doing?
what?
I don't
Yeah.
get it, really. If you said that today, I think it would be met
Yeah.
with, of
Congrats.
course. Yeah,
Yeah.
that's the growth area. So I do think the firm was intentional. I also was intentional from a career standpoint, Jeff. I was like, okay, I might be an okay at best structure at a bank. I actually think I have an ARB here where I can take derivative skill, apply it to the ETF, and it might be a pretty damn good ETF structure, right, in ETF land, because the skill set that existed at the banks during that era versus ETF land was very, very different, right? So I made kind of a personal bet. The firm made a bet. Uh, at the same time, this ship sailing for the utilization of active ETFs was kind of cementing itself, right? I can almost say 2021, it sort of hits that growth moment where the pendulum swings and we're no longer having that debate. So you fast forward to
You
today.
think, real quick, you think COVID was a piece of that? Like a lot of active managers sidestepped the drawdown there and like got back in quickly?
I wouldn't go there. I would start to spit poetic about, the retail crowd
Oh,
and what they were doing during
got it. Yeah.
COVID and what that led to. I think that was definitely a driver or an ingredient, but it would have happened with or without COVID. Maybe
Yeah.
it would
Yeah.
have been a little slower. Maybe it would have been a little, I don't really know. But it was probably an accelerant, but I don't think it was like the base case for why we got to where we ended up getting to. But if you look at like, title as a proxy, it's a proof point. So here we are, we're at anywhere right now between 75 billion and 80 billion in AUM. 5 years ago, we were about 4 billion.
It's
So that's
crazy.
a 20x, right? In a
Yeah.
short period of time. If you say slice up your business, what you would find is that the business today is 85% active. Okay.
Hmm.
So that's like the inverse of the industry, right? The industry
Right.
is probably the exact inverse of that, but we are heavily, heavily active. Then you say, how much is derivatives? I'm rounding here, but probably 30% of our AUM is a derivative ETF in some form or another.
Yeah.
Like, again, that's not 30% of the ETF ecosystem isn't, but
No.
we built in 2018. So our business probably reflects the forward curve of the ETF industry, not the legacy curve of the
Yeah.
ETF.
Got it. Yeah. Right. You're not, I mean, if someone came to you and said, I have a new, it's almost impossible to do, right? If I'm gonna do a new S&P ETF tracking the S&P. Like, no thanks.
No,
You
it's
would,
not happening. Now,
yeah,
where passive can still play, and we definitely participate, and they can lead to really exciting opportunities. I think about like thematic ETFs. You can absolutely still build good thematic ETFs around passive strategies. Sometimes that's going to make sense. But by the way, even there,
So that's like AI compute or something like
sure, but
flavor of the day.
but by the way, right, a shining example of Tidal success was all the way back to, I think, 2018 when we were involved in Block, BLOK, which was the
Yeah.
first crypto equity ETF. At that time, everybody would have built it passively. We didn't. Tidal built it actively because we thought when you have a market that's changing as quickly as crypto, right? Today, you could make the same case for AI. I would strongly encourage an active build where you've got PMs, think about like IPOs, right? Like, do you want to get involved in IPOs right out of the gate? Do you want potentially get IPO allocations at the IPO price? You can do all of those things in active ETFs. You basically can't do them in passive ETFs, although, not to go off track here, but obviously we see some of these
Lines are
massive
blurring.
indices changing their rules on the fly to accommodate these things. But again, it's a lot harder to change the rules than it is to just have the flexibility up front.
Love it. And so what's, maybe we'll say that, Tim, but so now 75 to 80 billion, how many ETFs?
430, 440.
430. And then is this the same trust? You just had to build one trust, or we had to do like
Yeah,
100 trusts?
definitely not. We
Yeah.
would have
There's
big
limits to
problems if
that.
we did it all in one trust. So actually, and this gives me an opportunity to talk about how we interact with the market as a whole. So 80 billion of assets under service, right? I'm using careful
Yeah.
words because not everything's under management, but that's a nuance. The majority of our business is that build that you describe where it's a trust. But even there, we have 4 going on 5 series trusts, right? Because you just can't manage that many sub-advisors, that many ETFs with the same group of trustees. That's not doing it right. That's not being a good fiduciary. So that matters. We also, over time, Jeff, have adapted our business to be more flexible in terms of how we work with clients. So an example of that is oftentimes we are just a trading sub-advisor. So we may be a sub-advisor for an ETF off of our trust, and we are the trading sub-advisor for those products. That's like a third of the business too. It's a great business. Some people don't realize that we do it. And that, by the way, like trading has just become kind of like, it's not really surprising probably to us, but the backbone of everything in some form or another is basically trading and cap markets for these products. And our headcount's a reflection of that. So we're about 240 employees today. A third of those, about 80, are traders, cap markets, maybe the middle office that's supporting trading, but basically a third of the headcount is locked in to the trading part of the business. And we see that as like probably our biggest differentiator now. I think you could argue, I'm sure maybe there's maybe a counterexample or two, but we're probably the largest ETF only trading desk on the street right now.
And then that third model that you're talking about is somewhat, I have an idea. I don't want to set up all the piping myself. Just, okay, you guys run it for me.
Yeah.
But I have my trust. Yeah. I have my own trust and everything. And you just are doing the execution.
Yeah. So the way I frame this is like business school stuff. Not that I went to business school, I didn't, but I imagine this is what they would teach you. It's kind of like classic build versus buy decision making, right?
Yeah.
So there's certainly going to be entities that want to get into the ETF space, and they think the best thing to do is build everything from the ground up. Others look at it and say, okay, we don't probably want to build everything from the ground up, but they may have some of the infrastructure in place. So for example, right, we work with very large managers. Raymond James is an example. Like Raymond James came to us, but they were already running mutual funds. They had the trust, but what they definitely didn't have was a trading cap market. So ultimately we plugged into their existing infrastructure to enhance that part of the puzzle. So as you can imagine, as we got larger, we've been working with larger and larger managers, and you don't really have an ability to force a single solution upon them anymore, right? You kind of have to meet them where they want to be met and where their deficiencies are. And that flexibility that we created is good for them. And it's obviously led to a lot of our growth and success.
Let's change for a second. I'm a brilliant trader guy. I want to start an ETF. I'm seeing all this growth. I'm listening to this podcast. Great. I've got an idea for an ETF. How does it work? Who do I call? I call you.
Yeah.
And then you asked me, like you said, active or passive. I'm going to, let's say active, because that's what we're doing here. What are the next steps? Like, give me some of the, like, if you don't have $100 million, forget it.
Sure.
If I said, oh, well, I want to skip that part, I'm going to start my own trust. What does that cost?
Yeah.
Like,
So I'll start
I don't know if
with
there's a question in there, but you know where I'm going.
yeah, and I think I get it. So first you knock on the door, right? And we start to engage with you. And we have a big team that is solely dedicated to that part of the engagement, right? New prospect, right? Knocks on the door, we start to engage. We kind of work through, these are Gavinisms at this point, but like the Gavinism is like there's a decision tree that we help that prospect walk through. The first decision is, do they want to launch an ETF? Okay. And in this moment in time, we are basically consultants for free.
Yeah.
And believe it or not, we're not in a business of convincing people to launch ETFs. I think the market does all that work for us, right? Most people are going to knock on the door and they're going to be excited, and they've knocked on the door for a reason already. So I have no interest in, persuading people to launch ETFs. In fact,
yeah, you're not cold calling firms saying, hey, you should start an ETF.
no, and we're certainly not going to allow somebody to be naive to the realities of the ETFs and how challenging it can be to grow ETFs, because we're only going to win, like now I'm talking economically, we only win if they win, right? Otherwise it's a waste of everybody's time and money. So that first decision is, do they want to launch an ETF? We're going to be there to give them a lot of information. Sometimes we're pouring a lot of cold water on things, right?
This is like, are you sure you want to do this?
Are you sure you want to do this? What's your sales strategy? What's your growth plan? You go back to an earlier example, Jeff, right? We see things come through the door. It's like, I've got this model thing that I've run on in an envelope for, the last 3 years. I have a back test and I'm going to deliver S&P 500, plus 100 basis points, and my Sharp's a little improved. All these, like, if I'm hearing nuanced improvement, I'm pretty much short it right out of the gate, because it's just like not enough differentiation in a world where you're competing with all of the juggernauts and thousands of products. So it's a mix. We tend to focus most on the product and the growth and sales strategy. So
and the product has to wow you. It has to be like, oh, cool, I haven't heard of this before.
And unless you have like a BYO, bring your own assets strategy, a massive sales force, or there's certainly a lot of firms that say, listen, I get it. I need to be in this for the long game. I'm going to need to build sales teams. I'm going to need to heavily invest. And I know it might take 5 years for me to really print significant performance. Well, those are reasonable expectations. We're happy to work with institutional grade managers who have healthy expectations. We don't want to work with institutional grade managers that have not realistic expectations, because that leads to tears, essentially, and blood on the playing field, right? You just don't want to do it. So that's the first decision. The second one is the one I referenced a few minutes ago, which is the build versus buy, right? So now that manager is saying, yes, I want to launch an ETF. And we're looking at them and saying, that seems reasonable. Okay. So now we're going to the build versus buy. Obviously, I have some bias at this point, right? I don't want them to build everything alone. Otherwise, they're not going to work with us. But back to the flexibility, we really hear them out and understand what they do or do not have in place. And then we look at that honestly and say, okay, we can fill certain voids and certain gaps. And based on those voids and gaps, that might be like the full stack solution, Jeff, where it's our serious trust. It might be the Raymond James example where we just step in on trading and cap markets. There's a spectrum there with more nuance, but really just trying to figure out like where they want to be met, give them a almost custom solution, right? And that's something that we can look at together and say, we think combined, you, prospect plus title, are going to have a better opportunity for a good outcome than you would have without title, right? If we don't truly believe we're going to be additive, we're going to walk away, because again, it's not going to end up in a good outcome. The third part of the decision, so if they're yes to an ETF and yes, they want to outsource something, okay, now we get into like hardcore sales. Like, why is title better than anybody else, right? We go down that path. That's where you get into the more classic business development. But step one and step two are probably 80% of the conversations we have. And again, I would just call it free consulting, right? So we spend a ton of time with great entities, great prospects that are focused on question one and question two before we even remotely get into should it be Tidal or should it be somebody else. That comes
And
last.
then take me through some of the step ones of like, hey, I've got a great symbol, and that's all they have. Are you
Yeah.
you're saying no? Like, what are some of the where conversations you have of like, hey, great talking to you, but this isn't nearly enough flushed out.
Yeah. So like a bad example would clearly be, repeating myself a little bit, that like mildly nuanced,
Yeah.
S&P exposure with not some kind of massive bring your
Like
own
I got a better
asset.
Sharp. Like you
Yeah,
can't
yeah.
eat Sharp. Yeah.
It's like how much of the ETF buying community knows what a Sharp ratio is, right? I
Yeah.
would say less than most answers would be given. So, so
Or that a point 0.6 Sharp is meaningfully better than a point 0.5 Sharp.
yeah, is
Like
that
you
really going
can't
to make
tell
them
really.
use a
Yeah.
new product, a new manager with maybe wider spread? So, when we look at a product, if it's significantly differentiated, and we like to use the word like white space, right? Are you really doing something that's hitting white space? Is it, the first CTA? Is it, one of the first five long short equities? Okay, you can start to get excited, right? You have a much more limited pool of competitors. Therefore, your opportunity for success is probably much higher than it would be. If it's not a truly differentiated product, if it's not close to or literally white space, then you've got to get into an understanding of who they are, right? Well, you're a 20-year asset manager with an amazing track record, with the sales team, with reasonable expectations for growth. They're in it for the long run. They know that it's not like, oh, I'm just going to launch a product and the assets are going to run through the door. Those are amazing conversations. We love to work with those partners. And there, what we're going to do is kind of enhance their existing resources and enhance their understanding of the ETF ecosystem, just to make them a little bit better and increase their odds a little bit more of success. So it's kind of a tale of two cities there. It's like
Yeah.
really, really awesome IP in the form of a product, or a franchise that has a true understanding of asset management and understands how to grow a product and has reasonable expectations.
And what do you see in your career and Tidal as a whole? Like right? I think it's, in my opinion, or what I've seen, if you're first, you have a great chance of success,
Yeah.
right? If you have that first idea, you're the first ETF, you're the first ticker, it starts trading, you get the first assets. But we've also seen, okay, someone had the idea and then the big behemoths come in, copy it, and then just their scale kind of overtakes it. So
Yeah.
is it better to be first or to be that franchise? Or
Well,
it does,
yeah, I think both can win. And
yeah.
we can use specific examples. So let me use a really good specific example that I had nothing to do with. So it's really like just easy to
Yeah.
talk about, right? So I go back to the defined outcome space.
Yeah.
Innovator ended up being first. Okay. So we're going to give them the first mover advantage of ETFs. They obviously built a multi tens of billions of dollar business that ultimately culminated in a sale to Goldman Sachs for $2 billion. So that was a massive success, right?
Yeah.
You can't argue it. And listen, the DNA of that firm was legacy ETF players. They understood what they would need to do to be successful. But first and foremost, they were first mover advantage. I think first mover advantage in ETF industry is not just highly rewarded, but probably way more than other industry. It really gives you a significant edge that actually lasts longer than people would expect. Staying with defined outcome, though, who was the second big player? Well, it was Vest, which was actually DNA that came out of some of my type of world, right, at banks. But then they partnered with First Trust. So they
Yeah.
weren't first, but they had the distribution figured out, right? So there's a clear example of number one being rewarded for first mover. Number two, first and foremost, in my opinion, not everybody will agree, but like, First Trust with Vest had the distribution. So clear room for both of those franchises to be very, very successful with defined outcome. Then though, this is where it gets negative, right? Then you had a long tail of other entities following or chasing that growth. And broadly speaking, really nobody had much success. And certainly nobody had really any significant success. You could say Allianz had some success, multi-billion, but they were obviously a large entity with a lot of assets that they could go and just grab too. So I think that is actually the poster child example where first mover is rewarded, second mover can win with distribution. But beyond that, you might as well get back to the lab and try to figure out the next big idea. Unfortunately, what I see across industry is, a little bit of laziness, right? It's like easier to see what else somebody else is doing and then go and try to copy it. Truly being in the lab and truly coming up with a unique new idea is harder, right? But a lot of people are
And
good
you
at it.
can't patent it. What does that look like? You can't,
Yeah,
right?
forget
Yeah.
that, right? I mean, this is
Yeah.
like, this is good and bad, right? Like on one hand, everybody would want somehow, and it's even, it's kind of, there's this new call for feedback from the SEC on novel product, and layered into that, by the way, from the staff is the potential of being able to maybe file without it being public. I would
Mm,
like that.
yeah.
And I think a lot of participants would like that because it would take some of the gamification away from the industry. On the other hand, though, like if you're operating in a highly competitive marketplace and you think you're a highly competitive player, who cares? Right? Like,
Yeah.
like,
Win.
like,
Yeah.
yeah, if you want, yeah, sure, the game would be easier, I guess, if I could somehow say I'm the only entity that can do option income overlay strategies. But man, what a terrible outcome. Let's go back to the end investors. Terrible outcome,
Yeah.
right?
Yeah.
Like,
One firm is just, yeah.
yeah, competition breeds good outcome for end investor. Let us drive our costs down. Let us make sure we're continuing to innovate to be the best example of that product there is. You take that away, and I guarantee you the end consumer loses. We can go off and talk about all kinds of other industry. I mean, imagine what it would look like if there was one, car manufacturer, right?
Yeah.
We'd all be driving a shitty Toyota Corolla.
One search engine. Oh, wait. Yeah.
Well, when you're really good, you can operate as a monopoly or ish for a period of
Yeah.
time, right? When you're really, really good.
Um, and then you mentioned the distribution, huge part of it too, right? So they're first mover. It's a great idea. You love everything. And they're like, no, let's launch it and the assets will come. You're like, yeah,
Well,
like that's not how it works. Securities are sold, not bought.
that's a tale of two cities. So what's interesting is if you go back to like the way I was framing it earlier, first mover, really white space, innovative idea, that's going to rhyme with the retail segment of the market,
Mm,
where the BYOA, the sales team, that's going to rhyme with the more institutional segment of the market. Now, I want to be careful with those words, by the way.
yeah.
When I say retail, I go back to the use of direct to consumer. I'm talking about a self-directed individual on a platform like Robinhood who sees a product that they think they want to buy, they press a button and they have bought it, right? That is the truest expression of retail. That is where there are literal, dream, field of dream outcome for ETF participants when they launch a first mover thematic ETF with no sales, maybe a little bit of marketing, and there's a virality around the product, right? In the Reddit spheres, the YouTube, spheres, wherever. And all of a sudden, a crowd of these truly self-directed retail investors go and buy product, right? That market.
You think that like 100 million or a billion? Like what can that get to with just that like grassroots stuff?
Okay. So that is exactly the right question, Jeff. And I'm going to give you exactly the answer.
Perfect.
10 years ago, I was educated on topics like this. And I was taught that your first number was the right answer. Literally, right? I could be quoted. Okay, Gavin, retail matters, but it can only get you so far. You'll get to 100 million. But if you want to get to billions, you're going to have to be institutional. Now, by the way,
Mm,
I don't think they were wrong 10 years ago. I think 10 years ago, that was probably right. Today, that is wrong. And I know it's wrong because I have examples from my partners that I have worked closely with that have built not just billions, tens of billions in assets that are 98, 99+% retail. So the
wow.
dichotomy has completely changed and shifted where you build a very successful business in either lane, retail or more institutional. And by the way, there's certain examples that can live in both lanes, right? And you can absolutely grow in both lanes successfully. And sometimes it starts it starts in the retail channel, and then over time it's the more institutional channel, right? It's all different examples.
And do you think
But
that actually is grassroots, or they're paying to have posts on Reddit and they have YouTube ads and they're doing like more guerrilla marketing, I'll call it, instead of like traditional, I have a ad in the Wall Street Journal or whatever.
definitely a mix of things. However, just, going back to some of these firsthand examples,
Yeah.
with very small budgets and just a little bit more, I'm not even going to say creativity, a willingness to embrace new channels of distribution and marketing,
Yeah.
massive success. So this is not first and foremost a world of pay to play. You can do this pretty grassroots, pretty organically, but what you do have to do is you have to respect those mediums and channels, and you do have to embrace them. What I mean by that, like to make that tangible, I'm really just talking about like, YouTube channels that are dedicated to specific niches of investing, like income investing, and a willingness for our clients and the PMs to go on those channels, spend an hour, talk about their investment philosophy, right? And that creates actually an amazing opportunity for the more entrepreneurial new entrants, because they probably have a willingness, or at least they have like, some heat at their back where they're saying, okay, I got to do something here, and I'm going to be creative. I'm going to go outside of like the traditional bounds to make this work, versus, right, like the very traditional old school asset managers and those PMs. You ask them to go on a channel like Darth Dividend on YouTube, and they're
Darth
going to like,
dividend.
no, what are you talking about? No way. So it actually creates a really nice edge for this newer community. And there's countless examples on the Tidal platform, countless examples off the platform where they're starting to embrace those channels. But again, I think that's early innings, and that's going to grow and expand and change rapidly.
But you could see some like suited up Boston stock guy running a value fund. Like, I'm not going on that site. Right? Like, just
100%.
kind of stuffy and like, no, that's not what we do. That's not how this works.
Even if the individual had a willingness, the mothership would
Yeah.
probably,
Say
throw
no
them
way.
out of the front door, right? You're like,
Yeah.
you don't get to work here anymore, buddy.
You mentioned pay for play. So I'm going to mention like, cool. We've had this talk. I've gone step 1, 2, 3. I've got the idea. I'm bringing, well, let's quickly say how much money do I need to bring and seed this with? And then 2, 10 years ago, or you tell me, when was it? As long as I had a ticker, it could really be traded anywhere. And nowadays, no, you have to be over this amount, or your entire fund platform needs to be over this amount in order to be on Schwab, or in order to be at
Yeah.
whatchamacallit. So what are some of those hurdles that are real hurdles for guys?
Yeah. So we'll start with the question around like seed, right? And of course, none of these things, this is good for the conversation. None of these things really work in isolation. Okay.
Yeah.
If you've got, again, a truly special first mover product, something that like just is interesting IP, and there's going to be demand for it, it doesn't matter, right? Because especially the true retail community, if they want the first photonic ETF, they're going to buy it, whether it's $1 million in AUM because the market maker seeded it, or it's
Yeah.
100 billion, right, from true allocations. It's not going to stop them.
They've
So
got like the posters all over the wall in their room. They're like, I'm buying this
that's
thing.
it,
Forget.
right?
Yeah.
Yeah. So if you're on that like bleeding edge of innovation, first mover product, truly innovative, that conversation kind of goes out the window right now. Again, that's not a common scenario though, right? Most people are not on that bleeding edge, the first mover. Most people are somewhere else. So then we start talking about specific numbers, 20, 50, and 100. And it actually bleeds into the second part of the question. So we have found that 20 million is absolutely the number that seems to, call it like, grease the wheels for allocators.
Yeah.
So this is like not science. It's not a scientific number. I didn't read it in a book. It's not because it gets approved on platforms. It's just through experience, we find that the average RIA allocator who has flexibility can look at a product and say, that's probably a healthy product. I'm not taking a huge amount of risk by allocating to it. And it makes sense, right? Because in the 20 million range for most product, you're getting towards about break even. So it probably means the product's going to be around. It's not going to close down, right? And that's important to an allocator. So 20 million is the first number we tend to talk about. If you're not innovative and you don't have a clear path to at least 10, don't launch. Like that's what we tell people, right? Just don't launch. The 0 to 10 is you're in purgatory. It is painful to live there, and you can get stuck there forever. And
clear path to 10 isn't, oh, I'm going to run Google ads or something.
No,
right?
A clear
it's
path
like I have this RIA that's funding it.
Yeah. And PS, you better have the list of RIAs that add up to 20 million
to get the
and
10,
then you haircut it by 50%, and then you have a clear path to 10, right? Because that happens more often than not as well. But 20 is when we've seen the wheels are greased. It's just easier to get an allocation. 50 and 100, right? So one, you're just, extending that same story of like the product's looking better and more and healthier. So more and more allocators are going to be willing. But now you're also talking about the second part of the question, Jeff. Like you're getting into platforms, you're getting into the opportunity to be approved, right? So you can look at 50 and 100 million. Those platforms, right? The private wealth channels, the independent broker dealers, all the names that we all know, they all have, hurdles. They all have certain thresholds. They all have different numbers. By the way, those numbers have tended to increase over time, unfortunately, right? So they're not going down, they're going up. And here's the real piece that nobody talks about. Okay. It's amazing. You've got an ETF, right? It's crossed 100 million. You're now ready. You're now capable of being approved at Morgan Stanley Private Wealth. Okay, first of all, that doesn't mean you're approved. It's not an auto approval on the vast majority of the platforms that really matter, right? So now you're just engaging with the gatekeepers. Okay, fine. You go through that process, you get approved, you celebrate, you're having a celebratory dinner, you're off to the races. Hold on a second. Like just because you're approved on the platform, how are you actually getting your story? How are you getting your product in front of all of the thousands and thousands and thousands of advisors, right? And that work is totally different, by the way. It's different than hand-to-hand combat with RIAs. You're talking about how
they're insulated in their own ecosystem.
Yeah. So that journey is long and slow, and you do it block by block. But obviously, if you're coming into this business and you're taking it seriously and you're planning for longevity, you're absolutely thinking about that all from day one. But you're not necessarily focused on getting approved at Morgan Stanley when you're at $1 million. You got to get to 10, you got to get 20, you got to get 50, you got to get 100, right? And different moments in time, depending on the product, depending on the partner, will have it focus on different channels. And that's where we're here to help our partners do that well.
Is there any number where you're auto in on those places? $1 billion,
not
5
at the
billion?
ones that matter, right? There's some platforms that are auto, but they're smaller, they're regional, whatever. What is, again, going back to the retail side of things, I'm just going to use Robinhood as the example because it's probably the one that most people would insert into a conversation like this. Back to the direct to consumer. I mean, this industry is goddamn amazing, Jeff. Right? you have an idea. You can if you can move quickly and file that product, you can do that in days. You've got a 75-day review period with the SEC. So call it, at its most rapid speed, 80 days. 80 days from idea to, in my words, fully manufactured product, right? And then on day one, that product is ready to be bought by, my word, the retail community, the Robinhood as an example. That product is on the shelf, right? So when you think, again, if you zoom out and you want to go like a different industry, if you're making like tomato sauce, right? Okay, it's one thing to like, okay, I'm going to start a tomato sauce brand. I don't know how long it takes to make jars of tomato sauce, but I'm sure it takes time, right? But then you've got this distribution problem, which
how do I get them in the
feels more of like the traditional distribution problems of ETFs. But you have this huge channel, right? And again, it's direct to consumer. So why have other industries like sneakers, right? Why have they just said, you know what? I don't want to deal with getting my sneakers in the stores of Walmart
Yeah.
and
Just buy them direct.
Costco because it's too hard. It's too difficult. I have to spend money to do it. Instead, I'm going to stand up a website and do some viral ads or whatever they, they might partner up with an influencer, whatever they're doing, right? You got to get eyeballs and then you got to make it easy to buy. And that's the direct to consumerness that can be applied to ETFs. And when it's done well and you have a really cool product, the opportunity is massive and only growing with time.
So put a bow on it all for me. So I'm me. I want to start my ETF. Time, we just said time could be 3 to 6 months. I need to come with at least 10 million, you said.
Well, again, depending on the product, if you've got a truly
Yeah.
awesome idea and
Well, you
I
can
look
give
at
me
it,
ranges.
my
So
team
give me
looks at it and
ranges.
says, that's an awesome idea, no problem. But yeah, more traditionally, let's say you at least have a really clear path to 10 million. I agree, Jeff.
All right. More's better. Yeah. But
More is
at
better.
least 10.
Yeah.
What do I need in the bank account to make it, no, my favorite line, no one doubts you're a pioneer. It's whether you're
Yeah.
going to starve in the Rockies.
Yeah.
Right. So
So
how do I
without
not
going into
starve in the
all
Rockies?
the inputs into the answer, I would just say top line, you probably want a couple million, I would say 2 to 5 in operating capital. How do I roughly get there? Well, one, I probably want you to be able to take a few shots on goal. If you only
Yeah.
if you only have capital for one product, we've all seen amazing product. You could be absolutely right. The product's amazing. You could still do it at the right time, but something works against you, right? Some outside factor. So I don't really love to engage with one trick pony sort of like clients,
Mm.
right? Like you should diversify your shots on goal. So that's one factor. And then it's buying time. You know, the good news about ETFs is the ETF industry market tends to actually tell you pretty quickly if you have something on your hands or not. So that's good. But still, I mean, you certainly need to run the product for a year. I would say at least
Yeah.
2 years. So, you kind of go 3 ETFs, 2 years running to really give yourself even a healthy dose. You add some marketing costs, some direct costs, XYZ, probably in that 2 to 5 million operating expense ballpark. You can scrape it together for less, but the odds that you're just going to burn it are much, much higher.
And then what are some other metrics? Like you should have a list of 5,000 RAs, or you should have like so many relationships or something, like some like kind of fuzzy metrics of like, cool, you've got all that money, but if you don't have, what kind of metrics could you put around the sales
It's some
plan?
mix of all those factors, right? So
Yeah.
you just like at the end of the day, you got to have a well thought out plan that you can clearly articulate. And we know when that seems to be the case, and we know when it's not the
Yeah.
case.
Yeah.
And it doesn't have to be one ingredient. It doesn't have to be a specific mix of those ingredients, but you've got to see it. And we've got very different, very, very different examples of massive success. But to me, it's all about eyeballs in some form or another. And how are you going to get in front of those eyeballs? That could be hand to hand combat. It can be marketing. It can be, you look at somebody like Tom Lee that we work with, who has a
Yeah.
$5 billion ETF business in under 2 years. Well, it's because he had a massive following already that was paying for his research, right? So it's a little case by case, but there's definitely only so many. There's probably 10 ingredients that kind of matter, right? It's just a mix of those ingredients that they think are going to be the driver of their success.
You're sometimes like, who's going to sell this thing? And the quant guy's like, me. And you're like,
Yeah,
I don't see it.
Yeah,
Yeah.
100%. Right. It's so good. It's going to sell itself. Well, if you're not talking about like to the tune of like a really significant outperformance opportunity, it's not going to do it. 100 basis points of outperformance over the S&P is not going to get the job done. It's going to take more.
All right, I got 3 quick things and we'll wrap up for you. You mentioned you've gotten on all those platforms to go out to celebrate. Where are you going to celebrate in New York?
In New York right now, I'm going to give you a really odd answer. You ready for this? Okay.
Perfect. Yeah.
The underappreciated Houston's, which is just
Houston's. Yeah.
reliable and high quality. And I dropped in there at like 9 o'clock the other day, grabbed a bar seat and got sushi that was like probably 9 out of 10 times better than 2 times as expensive.
Then
So,
Nobu. Yeah.
you know,
All
keep it
right. That
easy.
was for sure out of left field. And then I don't know if you can do this quickly, but prediction market ETFs, single stock future ETFs. Those are kind of two new growth areas, or you're seeing some people talk about those?
Uh, Prediction market's getting a lot of attention. Single stock futures less so. On the prediction side, we're mostly going to wait and see, right? I think this is a very appropriately scary topic for the regulators.
Yeah.
And I think they have already shown that they're going to take that very carefully. And as I honestly think they should, I love innovation. I love pressing the boundaries. But this is an example where if you if you get prediction market ETFs out in the form of ETFs, well, then it's like boundaryless, right?
Yeah.
You can
Yeah.
have prediction markets on anything, and we know what that could mean. So I think that's going to be slow going. We will see. So we're mostly going to be watchers there, and we're going to learn as we engage with regulators and clients. But we have Jeff definitely engaged with clients. We did a filing recently for one client, so we're a participant, but in a pretty mild sense so far. But like all things, it's going to be so fun. Like I mean
Right.
that, like just so fun to watch.
And the
Single
example
stock,
I've heard thrown around, right, is will the Dems win the House or the Senate in the
yeah,
midterms or something like,
yeah,
and that's
exactly.
an ETF. But then it confuses me. If they don't, it goes to zero. The
Well,
ETF's dead.
that's exactly the first things I started thinking about, Jeff. Is like
Yeah.
binary, right? I mean,
Yeah.
so
Like what?
designing a product that can go to
And then can you
zero
be selling
is
it all the way down? Like,
very
yeah.
outside of the like foundational base of what you would expect an ETF to do. And you have real questions there. Like, I guess you could design that it doesn't go to zero, right? Maybe you only invest 99%, so you never get to zero. There's all kinds of design elements and structuring things that you can start to think about.
Yeah.
But that's
Gets
probably a whole
crazy.
nother hour.
Yeah.
Then the single stock futures, I look at that more as like, obviously we could use, as long as they become liquid, we could start utilizing them in an ETF. I don't see any regulatory boundaries there. For firms like Tidal, like that's great, right? It's just more tools in the tool chest that allow you to design things, give you more flexibility, give you more options, right? To express certain outcomes. So it'd be a really nice tool to have once they're liquid and ready to trade.
Awesome. Any last thoughts before we let you go?
I love you, Jeff. It's been a pleasure. I love
We'll
working
see you
with
in
your
August,
firm,
maybe.
all the good
Yeah.
stuff. But listen, no, I think parting thoughts are, I love this industry. Hopefully that came through a little bit. I
Yeah.
truly think from an economic standpoint, it's an extremely attractive industry. And I will double down on my earlier statement. I'm going to say inning 2 or 3, not beyond. And I will come back on and, eat my hat if I am dead wrong on that. I will happily bet on it. And I basically have, right? I basically bet my career
Yeah.
on it.
I like to seen you, right? Like it's hard. You're drinking through a fire hose 24/7. But that's the fun part. That's
That's
why
what you
you're in it.
signed up for, right? That's what we all signed up for,
Exactly.
Jeff. You're doing the same. So it's
Woo.
all good.
All right, man. Great seeing you.
Thanks, buddy.
We'll talk soon. Thanks again.
Awesome. See you soon.
Okay, that's it for the episode. Thanks to Gavin for coming on. Thanks to RCM for sponsoring. Go check out that new website. Thanks to Jeff Berger for producing. We'll be off next week. Got to go out to Seattle for a brother's wedding/baby thing. That's its own podcast story. But we'll see you the week after that. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.